Hello Vancouver WSU VITA volunteer, and welcome to this presentation on the tax treatment of adjusted gross income. This presentation will serve as a general overview of the important items to consider when reviewing adjusted gross income deduction. In this lesson, we will cover adjustment of gross income, educator expenses deduction, penalty on early withdrawal of saving deduction, alimony paid deduction, and student loan interest deduction. So, how do I determine if the taxpayer has adjustment to the income? As we see here, this is the intake form, part 4. In this part, the taxpayer will answer this question which is coming to here regarding the expenses, and these expenses is regarding to the adjustment to income. If we see they have an answer yes, check, so we have to review with them and to identify the adjustment to income that taxpayer can claim. You will need to ask the taxpayer if they had the type of expenses listed in the adjustment to income section of Schedule 1 and review the taxpayer answer on their intake and interview sheet. And some of this question, it will be like, did you pay qualified educator expenses during the year, the tax year? Did you pay a penalty for early withdrawal of savings? Did you pay alimony? Or you pay student loan interest? Those, they are a basic and they are regarding to the adjustment to income. And there is, of course, another expenses which is regarding to the adjustment, but they are related to advance, not to the basic. So, what cover adjusted gross income? Adjustments are deductions that decrease a taxpayer's gross income. Total income minus adjustment equal adjusted gross income. Any increase to adjustment will ultimately lower taxpayer income and reduce income tax. And note that the adjustment don't lower other taxes, such as the self-employed tax. Adjustments are reported in Form 1040 Schedule 1 and deducted on Form 1040 or Form 1040 SR line 10. And then in line 11 in Form 1040 we get our adjusted gross income. Adjustment to income lower your adjusted gross income dollar to dollar. For example, the taxpayer has $20,000 in gross income and $300 in educator expenses deduction and $50 in the penalty on early withdrawal of savings deduction, $2,000 in alimony paid deduction, and $1,000 in student loan interest deduction. What is the taxpayer adjusted gross income? So in this case, we will take the $20,000 gross income and we deducted from it the $3,500, which is the total of expenses, and we will get adjusted gross income $16,500. Now we are going to cover the educator expenses deduction as a common adjustment. So an eligible educator is allowed to deduct up to $300 as a single or $600 as a married filing joint if both spouses are eligible educator as adjustment to income. And eligible educator is a kindergarten through 12th grade teacher, instructor, counselor, principal, or aide in school for at least 900 hours during the school year. And expenses must be qualified in order to take the adjustment to income. And the qualified expenses include ordinary and necessary expenses purchased, such as book, equipment, supply, and other material. And in the other equipment, it could be laptop if it is used for the school. And during the COVID, the any supply it was regarding to the protection the student, it was considered qualified expenses like mask and hand sanitizer and any other supplies needed. Expenses don't have to be required in order to be considered necessary. And homeschooling expenses are not considered qualified expenses. So what is the qualified expenses? The qualified expenses must be reduced by the interest on Series EE and 1 U.S. savings bonds that you exclude from income because you paid qualified higher education expenses. Any distribution from a qualified state tuition program that you exclude from income, and any tax-free withdrawal from your Coverdell education savings account, and any reimbursement you receive for expenses that aren't reported to you as a wages on your W-2. Next, we are going to cover the penalty on early withdrawal of savings deduction. So the taxpayer may have paid penalty for an early withdrawal from their savings account, usually a certificate of deposit, CD. This penalty can be identified on Form 1099 INT, which is interest income, Box 2, or Form 1099 OID, original issue discount, again in Box 2. The taxpayer will receive this form from their bank, and the early withdrawal penalty deduction is reported on Form 1040 Schedule 1, again as usual. Now we are going to cover the alimony paid as a common adjustment deduction. So what is alimony? Alimony is a payment to a spouse or former spouse under a divorce or legal separation instrument. The payment don't have to be made directly to the ex-spouse. For example, payment made on behalf of the ex-spouse for expenses specified in the instrument, such as medical bills, housing costs, and other expenses can qualify as alimony. But remember and note, alimony will not be deductible for any divorce decree executed or modified after 2018. And alimony paid is not reported as income for the other party, divorced spouse. So what requirements for payment to be considered alimony paid? First, the ex-spouse don't file marriage filing jointly. Second, the payment was in cash, like including check and money order. The divorce doesn't designate the payment as not alimony. The ex-spouse were not member of the same household when the payment was made. The other one is the alimony payment was designated in a divorce separation document and ordered by a judge. There is no liability to continue alimony payment after the death of the spouse that received the payment. The payment is not treated as a child support or property settlement. Alimony paid is reported, remember always, alimony paid is reported on the taxpayer form 1040, Schedule 1, line 18A. And the taxpayer must also have the Social Security number for ex-spouse they are making payment to. And this is reported on the Form 1040, Schedule 1, line 18B. And reported the date of the original divorce or separation agreement on Form 1040, Schedule 1, line 18C. And now we are going to cover the last common adjustment, which is student loan interest. So what it is? the student loan interest deduction. Student loan interest is the interest you pay during the year on qualified student loan. It includes both required and voluntary interest payments. You can reduce your income subject to tax by up to $2,500, which is the maximum benefit you can get. And this deduction, it is limited on modified adjusted gross income, which is the coming between 170,000 if married filing joint return, or 85,000 if single head of household or qualified widow. So what is your modified adjusted gross income? Actually, it is the adjusted gross income from Form 1040, line 11, plus student loan interest deduction, which is given to us the modified adjusted gross income. And your student loan interest will be qualified if your loan qualify. And your loan, it will be qualified if you took out the loan solely for higher education expenses. If you took out the loan for yourself, your spouse, or your dependent. The loan is not from someone related to you or from a qualified employer plan. And the student qualified to be a student qualified for the student loan interest, it should be incurred the higher education expenses around the time you took out the loan in the same year and enrolled in the higher education program at least half time. And the qualified education expenses are included tuition and fees, room and board, books and supply and equipment, and other necessary expenses such as transportation. And remember, you will fall under unaccepted filing status, and your student loan interest will not be qualified if someone claims you as a dependent on their tax return, or you are married and filing your taxes separately. So, and there is expenses reduced by offset, which is like employer-provided educational assistance or tax-free distribution from covered education saving account or qualified tuition program, and if excluded U.S. saving bond interested or certain scholarship and fellowship, veteran education assistance, or any other non-taxable payment like other than the gift or inheritance received as educational assistance. Now it is your turn to test your information, and there is exercise question. So the exercise saying Todd and Janet have a modified adjusted gross income below the limit. They are filing jointly. 2 years ago, they took out a loan so Todd's mother could earn her nurse degree at night school. Todd couldn't claim her as a dependent on his return because he didn't pay for more than one half of her support. This year, they pay $1,000 in interest on the loan. Does his mother meet the student qualification? Yes or no? So the answer is Todd's mother wasn't their dependent at the time they took out the loan, so she is not qualified. And by the end, I just want to remind you for our resources, which is our publication as a volunteer, VITA volunteer. We have the publication for 4012, which is volunteer resource guide, and the publication for 491, the training guide. And for this adjusted gross income, you can look at publication 970 CAP. So this is, and there is some other resources, and thank you very much.